House prices increased by 568%.
And the Federal Reserve issues warning over brewing US housing bubble. Home buyers have faced a tough choice during the swallow rapid price increases and forego typical steps like house inspections or risk getting left out of the real estate market. Those dynamics have caused some observers to question whether the US is repeating the housing bubble of the early 2000s, which led to a painful housing crash in 2006 and the Great Recession the following year. The answer, warns the Federal Reserve Bank of Dallas, is that the property market is showing signs of a brewing US housing bubble. So here, the article from CBS News talks about how economists look at exuberance and measure that, and how above 95% is abnormal explosive behavior. Currently, it's at 115%. They also look at valuation, comparing home prices against the sum of discounted future rents, similar to how we value stocks against future cash flows. And then they look at the ratio of home prices to disposable income. And so all of these things have risen significantly. Danielle Hale, the chief economist at Realtor.com, said that while the current rate of home price growth was unsustainable, it's hard to predict when the price increases will slow. Double-digit price increases and rent increases can't go on forever, she said. And the article finishes off, FOMO wave gives rise to concerns. Talks about some of the differences between 2022 and 2006, saying that 2006 people were in worse financial shape, liar loans, ninja loans, all that. But there's something else going on the economists have flagged as worrisome today, a fear of missing out, or FOMO. A wave of this FOMO exuberance involving new investors and more aggressive speculation among existing investors. A fallout from a housing correction from the current real estate boom wouldn't be similar to the 2007-2009 financial crisis, they said, but for some recent homeowners, a correction could still prove painful. And in Australia, we're seeing the same thing. Over the last 18 months, there has been huge FOMO, and we've seen a lot of first home buyers that have had no savings, buy in the last 18 months and do not care what they pay. They have maxed out their borrowing capacity to get into the property market at record low interest rates. They were given up to $40,000 that they could take out of their retirement savings, out of their superannuation funds. They were given state government homebuyer grants, federal government homebuyer grants to build a new home. If they moved to a regional area, they could get a little bit more grant from government. They then had homebuyer guarantees where they didn't have to pay mortgage insurance if they had less than 20% deposit. Stamp duty relief from state governments if they're a first home buyer. So we saw in our business a lot of first home buyers that had no savings in 2020, all of a sudden $85,000 to put down as a deposit, going towards the maximum of their borrowing capacity just to buy an average home. And we don't have the 30-year mortgages like they do in the US. So a lot of these first home buyers, they took out a 2, 3, 4, maybe a 5-year mortgage tops. Where do we think interest rates are going to be in, well, these people locked in, say, 18 months ago? They might have 18 more months left. Where do we think interest rates are going to be at the end of next year, in 2024, when they roll off? So I've shared this chart before, and in fact, this is an old chart. Dwelling prices have continued to rise while average full-time earnings have continued to go sideways. And this has been a debt bubble. This is just more and more debt going to housing. When we look at a chart for M3 for Australia, the currency supply, and then we add over the top Australian residential property, well, isn't there a correlation there for you? Steve Sematino tweeted this out. Well, Alan Kohler just blew my mind. Global house prices have increased 68% since 1980, and Australian house prices have increased by 568%. What's he talking about? Let's cut to a clip with Alan Kohler.
Well, it's obviously because immigration stopped, but the number of job vacancies rose 7% in February to 423,500, which is about 200,000 more than in February 2020. There is now one vacancy for every 33 people in the workforce, compared with 1 in 60 before the pandemic. And perhaps more importantly, there are 3 vacancies for every 4 unemployed people. Now, it's usually 1 vacancy for every 3, so you never know, wages might have to go up. Financial markets weren't so sure about that today, with the dollar slipping back below 75 US cents. The share market broke its 7-session streak with a small drop. Highlights included the Reject Shop, not rejected, JB Hi-Fi rejected, along with other retailers and banks, while miners went up after a solid gains by commodity prices last night, led by iron ore and base metals. And Asian markets fell after a small decline in New York last night. Finally, we find out about March house prices tomorrow, so here's a bit of context. A chart of national house prices since 1980, showing that they're currently about 20% above the long-term trend. Here's a similar chart of global house prices, also currently above trend, but only by about 10%. More importantly, the rise in real global house prices since 1980 is 68%. In Australia, over the same period, it's 568%. So if you think Australian house prices are out of whack with the rest of the world, you'd be right. And that's finance.
Alan Kohler, waking up from the Australian dream. The disaster of Australian house prices over the last 40 years has not just reshaped the economy, but fundamentally transformed society. In 1980, the median house value in Australia was $69,693. On Friday, we learnt that it's now $738,975, a rise of 25% in the past 18 months of the fastest growth in history, and a 960% increase since 1980. Australia's disadvantage is made worse by slow wages growth. In the vast majority of developed countries, houses have become cheaper relative to income over the past 40 to 50 years, while in Australia, that ratio has more than doubled. Well, there you go. The result of 6% compound annual growth in the value of houses over 40 years is that household debt has had to increase from half to twice average disposable income, and from 40% of GDP to 120%. So just let's back up for a second. So household debt has had to increase from half to twice average disposable income. So it's gone from 50% of average disposable income to over, 100%, 200%. In fact, I think I've shared charts in previous videos about this. This is the most important single factor or fact about the Australian economy, and will determine what happens to interest rates from here, and therefore to inflation, wages and growth. As far as the Australian economy is concerned, house prices are everything, and I've been talking about that on this channel for a long time. Land and energy are the 2 basic economic inputs, but while Australia has more of both than just about any other country, we export most of our energy and price our own at global parity, and we crowd into a few cities and pay each other 10 times our salary for the privilege. The ABS, Australian Bureau of Statistics, reported on Thursday that total household wealth in Australia had increased 20% in 12 months to $14.677 billion, an increase of 942% since the ABS started measuring household net wealth in 1990, which sounds nice but is almost entirely due to growth in the value of the places we live in. Rising house prices do not create wealth, they redistribute it. Well, obviously, as an Austrian economic analyst, we talk about saving first, investing into productive businesses that produce goods and services. That is what generates wealth, not the value of a financial asset. Destructive wealth. It means the level of household wealth is both meaningless and destructive. It's meaningless because we can't use the wealth to buy anything else, like a yacht or a fast car. Sell your house and you have to buy another one, or your children do. Well, this is the Keynesian wealth effect, that actually as the value of your house goes up, that you'll refinance, that you'll take equity out. Equity, mate, as the Commonwealth Bank would say, and use that to buy a new car, to put a pool in, to renovate the home, to go on a holiday or whatever. So once again, our economy is a debt-fueled Keynesian system, where we have this wealth effect. We think we're wealthier, so we'll borrow against the equity or against the paper value of that asset. And most of the wealth is concentrated in Sydney, where the median house value is 1.1 million, double Perth's and regional Australia's. It's destructive because of the inequality that results. With so much wealth concentrated in the home, it stays with those who already own a house and within families. For someone with little or no family housing equity behind them, it's virtually impossible to break out of the cycle and build new wealth. The growth in the value of land has fundamentally changed society in two ways. First, generations of young Australians are being impoverished by the cost of shelter, especially if it's somewhere near a CBD. And second, the way wealth is generated has changed. Education and hard work no longer determine how wealthy you are. Now it comes down to where you live and what sort of house you inherit. It means Australia is no longer an egalitarian meritocracy. Material success is a function of geography and class, not accomplishment. Moreover, the geographic wealth gap is being widened by climate change, as floods and that's not what the Australian chief scientists will say. You know what? I'm not going down that route. Generational divide. At some point, millennials and Gen Zs will probably rise up in protest against the baby boomers, as the ballooning cost of their parents' and grandparents' aged care is added to the cost of their own housing. We do have a big problem with this, but that's because people expect governments to provide everything. 2 weeks ago, the 18th inquiry into housing affordability, this time by the House of Representatives Standing Committee on Tax and Revenue, concluded with a report titled The Australian Dream: Inquiry into Housing Affordability and Supply in Australia. Actually, the Australian dream is that a group of politicians might be capable of doing something useful about housing affordability. Inquiries like this have been going on since 1970s, and this latest one, for which 205 submissions were diligently prepared and sent in, was hobbled from the start by its terms of reference, which required it to focus exclusively on supply. Yeah, that's the thing right there. It was a waste of time. That's because the government, whose MP Jason Falinski chaired the inquiry, doesn't want to talk about the taxation of housing and land, having won the 2019 election by hammering the ALP's plan to do something about the taxation of housing and land. The result is that it was a party lines report, with all of the Labor members dissenting, and the majority of recommendations either repeats of previous motherhood statements about planning or so general as to be useless. It was pathetic. One of the pithiest comments came from the submission of Leith Van Onselen on the newsletter Macro Business, who wrote, among other things, "Let's get real and admit that this inquiry is a waste of time and taxpayers' money." And so it was. The supply of housing does need to be considered, but the fact that the house prices have gone up at the fastest rate in history over the past 18 months while there have been zero immigration and an oversupply of houses suggests that other things are perhaps more important, such as demand and bidding power, grotesquely amplified as they are by minuscule interest rates, tax breaks, and government grants for first home buyers. What the Standing Committee's report should have said is that the level of house prices and debt in Australia is a blunder, perhaps the biggest policy mistake in 50 years. If Labor wins the election, there will be another inquiry, but at least the same submissions can all be reused. Here's the thing. Since the beginning of the cough, 2020, when that happened, when people were laid off, when people were told to stay at home, banks allowed people to defer their loan repayments. And so no one needed to sell their home. And so we saw sales fall to record levels. The number of houses on the market. And then you had people wanting to move, work from home. So all of a sudden, some demand started picking up. And when no one's selling their homes, all of a sudden we start seeing price increases. The government, as I said, the government gave first home buyers who had no deposit, they could get up to $85,000 as a down payment on a house and pay no mortgage insurance, etc., etc. And the banks were willing to lend. And so we had this perfect concoction for higher house prices. And then as house prices began to rise, we had a lot of customers that were behind in their mortgage. And we said to them, you're not going to catch up. You need to sell. And their attitude was, no, we're not going to sell yet. We're going to wait as long as possible because the longer we wait, the more we can sell our home for. That was their attitude. And that was an attitude right across the country. Why sell now when I can hold out longer and get more for it? And then you had the first home buyers in particular who had FOMO, fear of missing out. They're like, well, if I don't just go all in right now, I'll never get a home. And so we just had interest rates rock bottom. People were locking in fixed rates, 4 and 5 year fixed rate at 1.89. So people maxing out their borrowing capacity. First home buyers being able to access $85,000 as a down payment. No mortgage insurance. Mortgage deferrals from the bank, so no one was forced to sell their home. And now we've got a crack up boom, as the Austrian economists call a crack up boom. We have a crack up boom, ladies and gentlemen. Mark my words, we have a crack up boom. And what did Ludwig von Mises say in 1928, 1929? He said there was a crack up boom, and this thing is going to pop, and this thing is going to crash, and we are going to have a depression. And everyone laughed at him. Everyone said you're crazy. Well, right across the world, whether it's Australia, the US, right across the world, the Western world anyway, we've had a crack-up boom, artificially created by central banks and governments. How they get us out of this mess, we've got an inflation problem, interest rates are rising. Yeah, let's see how this ends. Let's see how this all plays out. There's so many people out there with different theories. Now, I've looked into all of them, and some are much better, much stronger than others. But yeah, it's going to be very interesting to see what happens. Anyway, love to see your thoughts in the comments, opinions in the comments below, guys. What do you guys think? Do you think that people who bought in the last couple of years in particular are heading for some pain in the years ahead? Or do you think these house prices can continue to rise the way they are? Well, certainly if banks continue to increase lending, then of course. But if lending slows, well, we've got a big problem. If you understand how our monetary system actually works, lending needs to increase year after year after year after year. Lending has to continue to increase. If it doesn't, then people have got a big problem. We have a big problem. And I think this whole monetary system that we're in is coming to an end. There's big changes happening right now. And I think people need to be very careful. Anyway, love to see your thoughts and opinions in the comments below. As usual, if you like this video, please hit that like button. Really do appreciate it. If you haven't yet subscribed, please do so. Also, hit that notification bell. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.